Hello, good afternoon, and welcome to HYCM's webinar FX Week Ahead Live Market Analysis with myself, Giles Coughlin. I'm the Chief Currency Analyst here at HYCM, and I'm going to be taking you ahead the week that we've got coming up. We've got a number of different events that's coming in, and the market's digesting some key events from last week. So we'll be looking at some key things that's on my radar. And before we go, we'll just get going through the webinar. Just going to go through. Hi Nadir, thanks for mentioning that. You can hear me all okay, I assume. If you've got any problems, just mention it on the question panel. That would be super. Just to make it clear that as we're going through different scenarios, different currency pairs, the whole idea of the webinars is not trading advice. The whole idea is education. It's about informing you guys how I go about making my trading decisions so that you can make better trading decisions for yourself. So that's the whole idea of this. We're not making a signal, a service or a trading service that revolves around sending FX signals. It's all about education and helping you guys make decisions for yourself. Okay, with that being said, let's get into the week ahead. And we started off with some risk sentiment being supported. Now, what happened was Donald Trump over the Friday, the end of last week, once the FX markets were closed, he has said he's postponed the tariffs that were due to be in place on Mexico today. And so, you know, the difficulty last week was that Donald Trump was starting tariffs on two fronts. He was fighting tariffs against China and fighting tariffs against Mexico. He has since dialed back the threat of the tariffs on Mexico, and so we saw some relief coming through the markets as soon as the markets opened on Sunday evening. Overnight Asian equities were supported. The Hang Seng, the Nikkei, both bourses were up. We also had strength in European equities, and the S&P 500 futures are up as well. And the market's just generally, you know, experiencing relief from the dialing back of those Mexican tariffs. We've also seen a lot of US dollar strength, and a lot of that US dollar strength is tied up with the relief that's coming into the market from this one trade front that's being reduced. One currency pair to make just to make you aware of is obviously the US dollar Mexican dollar pair. I'll just bring that over here. I'll just take that, just take a screenshot of that and drag it across in a second. So the Mexican peso obviously appreciated a lot on the announcement. So this is today's candle, and you can see the price just shot down. You see this was the price as the US dollar Mexican peso rallied on the back of that news that that Donald Trump would be placing tariffs on Mexico. We saw the Mexican peso weaken, US dollar appreciate, and now we're seeing the reverse of those moves. We're seeing the Mexican peso appreciate. Now, just technically, it's just interesting as a learning point to see how price moved technically. We had this very clear descending trend line. We had the 100, 200 exponential moving average, and we had this overhead pivot point here. So on the announcement of the tariffs, we saw a clean break of the pivot point, clean break of that descending trend line, and price moved up into the next pivot point. Now, what we're seeing is price moved down through the pivot point, and price just retesting the underside of that descending trend line. Often when you draw in a trend line, you might think, okay, I draw it from there to, and that's the end of the trend line. Extend the trend line through, and you see that price often respects the extension of the trend line as well. So this is just a really good example of how when anyone who was long Mexican peso, as the Mexican peso appreciated, an obvious place to take profit was in this sort of 1912 kind of region where you've got the 100, 200 exponential moving average, and you've got the 200, you've got the descending trend line. So that would be a very key area potentially. So that's just a learning point that's worth saying. So we've still got the global growth concerns, US, China, but the Mexico, US growth concern has gone for now. Although don't be surprised if you see this coming back, because Donald Trump was saying earlier in the session today, he was saying, you know, we can always reinstitute those tariffs if we need to. So, as is typical with President Trump, things blow hot and blow cold. What's interesting for me now is when you're thinking about the way Trump has handled a number of trade disputes, what we're starting to see is a pattern in Trump's behavior. If you remember the NAFTA agreement between US, Mexico, and Canada, how Donald Trump eventually got a deal done with Canada, he got a deal done with Mexico. We've seen today that he's, you know, well, at the end of last week, but with the market, the impacts being felt today in the market, the US have stopped those tariffs on Mexico. So this is, in my mind, this is positive news looking ahead for a US-China deal to get done. So, you know, the market has been hoping for a long time that Donald Trump would get a deal done with China. It hasn't been happening, but, you know, it looks like when it really, because the market was really concerned that if US is having a trade war against Mexico and China, the impact could be really quite acute, could be a strong impact. So I think Donald Trump's going to, you know, is going to dial back the trade war when it really matters. Obviously, that's not really tradable at the moment. It's just worth bearing in mind and being aware of that reversal that I'm expecting to see from Donald Trump. When that is, I don't know, but he won't want to see things plummet very far, particularly US equities. That's Donald Trump's big concern. He has his focus on S&P 500, the Dow. When the S&P 500, the Dow are increasing, Donald Trump's very happy. If we start seeing falls in the US equity markets, S&P 500 tumbling, Dow tumbling, that's when Donald Trump is going to step in and act. That's why we see this flip-flop approach from Donald Trump. Sometimes he's talking a combative language against China, and sometimes he's dialing it back, confident the deal will be done. He's just trying to oscillate between these two extremes in the market. We saw some China May trade data already out today, and we saw some increase in exports and a decrease in imports. And let me just take you through this data point. Now, this is in US dollar terms. The China trade balance was a big beat at 41.65 billion versus 23.2 billion expected. Now, the exports have bumped up 1.1% versus a minus 3.8% expected. Now, that is a very strong number, and many people are putting that strong number down to more orders being placed before the increasing tariffs really are felt by the consumers in the US. So that's what's happening here. China is exporting more products. Global growth is slowing. You look at the signs around the world, particularly German manufacturing, and there was some Italian manufacturing out last week. It's not a big data point, but it's just symptomatic of further falls. We had falls in UK data today. So this high number in Chinese exports is simply inventory building ahead of more tariffs and deadlines. So the market isn't really very optimistic about this number. There was a slight, increase in risk when that headline came out, but medium term, that's not going to be supportive because it's just orders being placed in early. And look at the import market. Now, this is the worrying sign for me. Minus 8.5% year on year versus 3.3% expected. So that is a big miss. And this is telling you that Chinese domestic demand is extremely low, is weakening. So in other words, the people within China are starting to spend less. Okay, so there's less demand. Growth is slowing within the real Chinese economy. So that's something to be aware of. It wasn't a great data point out of China, and the market's constantly looking at data out of China to get a lead on the global growth story. So just stay tuned into Chinese data through the week. Okay, for the UK, we had first chance of Q2 data, and it wasn't very good. Although the trade balance was a beat at minus 12.1 billion versus 13 billion expected, some of the the detail was very bad. So exports fell by 8.4% and imports fell by 12.7% on the month. So, exporting less and importing less. So less production, less domestic demand. So that's quite poor data out of the UK. And looking at manufacturing production, minus 3.9% versus minus 1.4%. That's the biggest drop since 2002. The headline GDP data out, which is also out this morning, was minus 0.4% versus minus 0.1%. That's the biggest drop since 2016. And industrial production, minus 2.7% versus minus 1%, biggest drop since 2012. So take all those data points together, and it's telling you that there's a big slowdown in the UK economy. Now, again, some of the detail is misleading here. And some of the detail is that because this period covers the old Brexit exit date. So in the UK, there's a traditional time when all car manufacturers stop working at a certain point in the summer. And because of the way that car production works, it doesn't make sense if one factory is on holiday in April and another factory is on holiday in June, and they all have different times because of supply chains. So they all have their holidays at the same time. Now that was brought forward early in order to allow for a Brexit change. So that data is in this set of results, which is what has skewed the GDP and the particular manufacturing production levels. Okay, so just to be aware of that, although it's bad data for the UK, it's partially skewed by what we've seen with the UK car manufacturing. We've got oil prices falling on global growth concerns, a slight pickup on oil at the end of last week, as there's hopes that Saudi Arabia are going to be able to persuade Russia to keep on with the OPEC extension agreement this week. The problem has been is that Saudi really wants to keep the extensions going, but Russia has been a little bit less inclined to keep the extension going because the Russians' view is that they haven't wanted to bow to pressure from the US shale producers. So that's why there's been some tension between Saudi and Russia has been recently making sounds that they're going to work together with Saudi Arabia. But the risk for the oil market here is if Russia suddenly say, look, we don't want to deal with Saudi Arabia, we don't want to agree to extensions of cuts, then expect oil to fall, because we've seen some oil bids into the end of last week on expectations that OPEC's agreement is going to be agreed this week. So keep an eye. I think they're meeting on Thursday, so just keep an eye on that story, particularly Russia. If Russia are reluctant to deal, we're going to see oil prices continue to fall. So let's have a look at the start of the week. Again, week ahead, thing to be big in mind is the US-China trade dispute. The trade war continued, looks to carry on for the next week. Remember, with the US and China making up nearly 40% of global GDP, expect more risk-off trading in the coming week if this mood continues. Okay, so if we see more US-China trade dispute, we're going to certainly see Japanese yen and Swiss franc strength. The US dollar is a bit of a question mark at the moment, and I'll explain why as we go through the seminar. While the US dollar is a slightly more complicated picture. But look, if this gets worse, if US-China trade dispute gets worse, then we're going to see more yen and Swiss franc strength. So be cued into that. Remember, what I'm trying to do as a trader is I'm always trying to pair a weak currency with a strong currency. So potentially great opportunities come when you get some risk-off trading, where you maybe get the US-China trade dispute flaring up, you see some yen strength and Swiss franc strength, and then straight away you've got, oh, I've got a strong currency And then I just look to pair it with a weak currency, depending on other stories that are going on at the time. Okay, so let's look at the week ahead. We've seen the Chinese trade balance, and we've had the data out of there. We've dealt with the GDP data out of the UK. Heading up today, we've got some JOLTS job opening. And the thing to generally remember the US is there was some very weak non-farm payroll data on Friday. It was something like 75,000 jobs added versus 175,000. And a lot of the data points were weaker across the board. And money market started pricing in a 80% chance of a Federal Reserve rate cut for July. So all the US data this week is going to be viewed in the light of this question, which is, are the Federal Reserve going to be cutting rates in July? The more likely it seems the Federal Reserve will cut rates in July, we're going to see US dollar weakness. Now, entering in this morning, we have US dollar strength. Now, some of that is just a rallying of the US dollar on the improved risk sentiment with the US and China trade deal getting done. But going forward for the larger moves, we still have to wait to see what is happening with the US data. If the US data, particularly we've got CPI, we'll cover through it as we go through, but that's just the story to be aware of. That's what the question is asking. Will the Federal Reserve cut interest rates? And the answer to that question is going to show a direction for the US dollar going forward. And we'll deal with it as we go through to the CPI data on Wednesday out of the US. But that's today, that's Monday. For Tuesday, we have average earnings out for the UK. The average earnings have been pretty good for the pound. So I would expect that earnings data to carry on. Apart from that, we haven't got anything that I'm expecting to move the markets. So there's nothing there that I've got on my radar. We've got the Assistant Governor, Kent, speaking, could potentially move Australia dollar as people try to work out what the Reserve Bank of Australia are doing moving forward. Obviously, they cut interest rates last week, and that was the first time since 2016. So traders will be eyeing his speech for any clues, though Governor Lowe would be more market moving than the Assistant Governor. Obviously, depending on what he says, but you get the idea. Okay, on Wednesday, an interesting day out. On Wednesday, we have CPI and PPI data out of China. So that, again, will be eyed carefully. Traders are looking for slowdown in global growth, and the proxy currency for the Chinese yuan is Australian dollar. So the more kind of weak data we see out of China, then we're going to see weakness in the Australian dollar. So keep aware of that story. In the CPI data and core CPI data out of the US, now this is going to be probably the most important piece of US data out. And what's going to be looking at here is, okay, if this CPI data, this inflation data comes out weak, then it's going to mean that the Federal Reserve is more likely to cut rates in July. And we're going to see more US dollar weakness on the back of that data. Obviously, if that was a big data miss, then we'd see quite a lot of US dollar weakness coming into the market. So just to be aware of that CPI data, that's going to be the first kind of clue after the non-farm payrolls on Friday. That will give us the first inclination of what the Federal Reserve is doing. And I was looking at the data, and I think I saw the markets had a probability of 80% for a rate cut in July, and there was about a 66% chance of a 25 basis points a rate cut, and then a 13% chance of a half a percentage point basis point. So the key thing, very weak inflation is going to increase the chances of a greater chance of a larger rate cut in July and greater chance of rate cuts in September's meeting as well. So that's the kind of data point to be looking at. That's the way to be translating it. That's the narrative going on at the moment around the US dollar. That's the That's the big narrative, is what's the Federal Reserve going to do next. We've obviously covered the PPI and CPI data out for China. We've covered that. That's the speculation after the weak non-farm payroll data. Now on Thursday, now we've got a couple of events here on Thursday. There's one large event that I'm looking for, and this is the Australian dollar employment change. So we've got employment change of 16,000 and unemployment rate of 5.1%. Obviously, the lower that unemployment rate figure is, the better. You know, the more people are unemployed, the better. And employment change, the higher that number is, the better. But again, it depends on the detail, because it's better to have more full-time jobs than part-time jobs. So we want to make sure that we look into the detail of those two data points. Now, the Reserve Bank of Australia, they cut interest rates, and the market's trying to work out, you know, how much more likely is the Reserve Bank of Australia to cut interest rates further. Now, one of the important data points for the Reserve Bank of Australia is their labour data. They highlighted it again in their rate statement last week, and we will be looking at this to see that the central bank is focused on it. Okay, so this is one of the things you want to find out, is what data points are central banks focused on, because the data points central banks are focusing on have the most impact, understandably. This is one of those data points. So this has considerable importance for the path of the Australian dollar. If this is a bad number, then there's going to be further chances of rate cuts from Australia. If it's a really good number, then it's going to be more likely the Australian rates stay put. So that's the narrative that's taking place on the Australian dollar. And if you look at the figures here, you can see, look, this is the unemployment rate. It's been dropping, okay, and that's good. Okay, the further the unemployment rate drops, that's the better for the Australian economy. We've seen the employment change, which is the green bar, and you can see here, you read it against the left scale, you know, that is showing, you know, it's above 0, so you know, there's more jobs being added, so that's very good news for the Australian economy. So this week will be key. Okay, so if we see unemployment rate, if we see the unemployment rate going up and the employment numbers going down, that's going to be weak for the Australian dollar. So be very aware of that going forward. Thursday, again, you know, coming to the European session, we've got the rate statement nice and early. Now, the Swiss National Bank, and they've got their press conference half an hour later. So just remember, with these kind of events, again, a learning point. Don't just see the one event, think, okay, there's the policy assessment, there's the legal rate. Okay, I'll ignore it. I'll wait for that data. See the events as a whole. You've got the assessment and the press conference. Now, at the press conference, Thomas Jordan, the governor, will be speaking, and I'll just show you. I'll just tell you what's going on with the Swiss National Bank. Okay, they have kept their I'm sorry, they've kept their interest rates very low recently. It's minus 0.75%, and there's no change expected in these interest rates. Now, the reason they have these interest rates so low is they want to discourage people from buying the Swiss franc. Okay, so by having these negative interest rates, it discourages people from buying the Swiss franc. Now, recently, and as you guys will know, which currency appreciates when the market is scared or concerned? It's the Swiss franc. So the more the Swiss franc appreciates, the more concerned the Swiss National Bank become. So the risk for Thursday is for the Swiss franc to end up weakening, because if the bank says, look, we're really concerned about the strength of the Swiss franc, and we are, you know, considering intervening in the currency again, or they say comments about we're always ready to intervene in the currency, they'll expect to see the Swiss franc fall, okay? Because it's strong at the moment. It's been very strong on the US-China global trade wars. So when Thomas Jordan speaks That's the key risk to be aware of. Hang on, so just grab a drink a minute. Apologies. Okay, that's a bit better. So yeah, that's the thing to be aware of. 7:30, 8 a.m. Thursday, June the 13th. You'd almost get some kind of acknowledgement of the strength in the Swiss franc. So be aware of some weakening of the Swiss franc at that time. Okay. Friday, we have the final important data out of the US, which is the retail sales. Again, that will be quite important for the US economy, how the US economy is doing. And market participants will be investigating. Oh, I'm very sorry. I'll be back in 2 seconds. I'm going to grab a glass of water. Okay, thank you for your patience. Apologies for that. I had something in my throat. I've got some water now, so I can deal with it. Yeah, so the Friday's the last day. You've got these US retail sales out, and so the market is going to be looking at how's the US economy doing. We're balancing it in line with Wednesday's CPI data. This Friday data will be key as well. Just forms a picture. Are the Federal Reserve going to be cutting interest rates? We also have Bank of England's Governor Mark Carney speaking. Earlier in the session today, we had some talk from the Bank of England that the Bank of England were considering hiking interest rates, and that they were more likely to be doing it, that they could do with a one hike. Now, the poor GDP data out today is probably going to push that expectation back. But again, we're going to be here, Mark Carney speaking. And of course, with the pound, we've still got Brexit-related risk as the new Conservative Party leader is being chosen. Boris Johnson is the current leader. He's in line to win. But the market will be looking who will be replacing Theresa May. And that will be key for the pound risk going forward. As it stands, Britain is set to leave the European Union on the 31st of October. And all the sort of replacement Conservative leaders are beginning to put their view across as to how they think Brexit should go. So you can follow that. You can Google that, look on Bloomberg. BBC website, very good, bbc.co.uk. I will just give that website out here. I'll send that to everyone here, bbc.co.uk. If you go to the bbc.co.uk website, you can look at the tabs under politics, and that can be very helpful for seeing the latest in the Conservative Tory race. There was a commentator called Laura Koonsberg, and I find her very helpful when it comes to UK political matters. And obviously, I live in the UK, so it's always best to get a UK source, and so there you have one there. That is the week ahead. So there's quite a lot going on, not necessarily much in big data points, but potentially there's some big stories that are being moved around. So the data points this week will help push them one way or the other. Don't forget some of the different services we have here. We had, when you deposit $1,500 at HYCM, you get an hour coaching session with myself. 3,000, you get an hour trading follow-up review. 10,000, you get 2-hour coaching session with myself, hour review, and 1 week's VIP support. Don't forget that this is not money you pay for the coaching. This is money you deposit in your own account for you yourself to trade with. So that just to be aware of that service that's being offered. Okay, don't forget tomorrow, 1 o'clock, 2 o'clock GMT time, we have the workshop with myself. And we'll be looking at some, putting into practice some key places to enter, how to do exits, how to manage risk, and how to find that on a day-to-day basis. Okay, guys, I hope you have a good week, and I hope to see some of you tomorrow. Take care now, guys. Goodbye.